Hello and welcome. So, you're a non-resident, you've got a U.S. LLC. This explainer is for you. Look, navigating U.S. federal tax can be, well, a real headache. But you absolutely have to understand your obligations. Today, we're going to break down exactly what you need to know to stay compliant, and more importantly, how to avoid some really severe penalties. Let's just dive right in. I want to start with just this one number, $25,000. Honestly, this is the biggest reason you need to pay super close attention for the next few minutes. And no, that's not your revenue. It's not a tax bill. It's a potential penalty.
And that is the part that gets everybody. This is not a tax on your profits. It is a massive, and I mean massive, penalty the IRS can hit you with for not filing a single piece of paper correctly. So even if your LLC made zero money, literally nothing, you could still be on the hook for this.
So let's get right into the thick of it. What is this mistake? We need to identify the core problem that catches so many foreign owners completely off guard. And believe me, it all comes down to one specific form.
This is the one right here, Form 5472. Now, I want you to notice the wording on the slide, Information Reporting Form. That is such an important distinction. This is not an income tax return. You're not paying taxes with this. Its whole purpose is just to tell the IRS about transactions between you and your U.S. company. But, as we've seen, ignoring it has some pretty extreme consequences.
And here's the trap. This is where so many people go wrong. They think, well, my company didn't do any business this year, so obviously I don't need to file anything. And that assumption, well, it can be a $25,000 mistake. The IRS requires this form even if your LLC was totally dormant. It's wild, I know. Okay, so before we go any further, let's just make sure we're all on the same page here. Do these rules even apply to you? Let's do a real quick check on how the IRS actually defines a non-resident for tax purposes. The IRS makes it pretty simple, really. It's a three-part test. So, 1, you're not a U.S. citizen. 2, you don't have a green card. And 3, you don't need something called the substantial presence test, which is basically just a fancy IRS formula for how much time you've spent in the U.S. If you can say yes to all 3 of those, then for tax purposes, you are a non-resident alien. This slide really gets to the heart of the confusion. So many entrepreneurs assume that, because they live abroad and they don't have any U.S. employees or a physical office, they're totally off the hook with the IRS. But nope. As you can see, none of those things automatically mean your U.S. company gets a pass on its filing requirements.
All right, let's move on and see how this all fits together. Because understanding the different forms and what they're for is absolutely crucial. It's not just about filing something. It's about filing the right thing.
Okay, let's break this down. A good way to look at it is like you have 2 separate doors. Behind door number 1, you've got Form 5472. That's all about information reporting for your LLC. And behind door number 2, you have Form 1040-NR. That is an actual income tax return for you, the individual. They do totally different things, and they're triggered by different activities.
Here's a great analogy. Just think of Form 5472 as a census form for your company. The IRS isn't asking for tax money with this form. They're just gathering data. They simply want to know about the relationship and the financial interactions between a U.S. entity and its foreign owner. That's it. So what exactly counts as a reportable transaction that forces you to file? Well, the list is pretty broad. For example, did you put your own money into the company to get it started? That's a capital contribution. It's reportable. Did you loan the LLC money, or did it loan you money? Yep, that counts too. Even something as simple as reimbursing yourself for a business expense, that can trigger the need to file Form 5472.
Now, here's a weird little quirk that comes with Form 5472. You have to attach something called a Proforma Form 1120. Don't let the name fool you. It's not a corporate tax return. Think of it as just a cover sheet. You put your LLC's basic info on it, list income and expenses as 0, and it just helps the IRS computers process your real filing, the 5472. Okay, now let's swing back to that other door we talked about, the actual income tax return. The main trigger for this one is whether you're engaged in a U.S. trade or business, or USTB for short. This basically means you're doing regular, continuous business in the U.S. If your LLC's activity hits that bar, then you probably have to file a Form 1040-NR to report and pay tax on any income you've earned.
All right, we've covered the what and the why. Now for the really important part. Let's talk about the most common and costly mistakes that non-resident owners make, so you can just, not make them.
So with all these different forms and rules, where do things usually fall apart? What are the specific missteps that lead directly to getting that dreaded $25,000 penalty notice in the mail from the IRS?
Let's walk through this minefield of common mistakes. The biggest one, like we've said, is thinking no income means no filing. Huge trap. Another one is ignoring Form 5472 just because it's an informational form. Then there are other things, like mixing your personal and business money, which makes reporting a nightmare, or just flat out missing the deadline. All these paths can lead to the same painful destination, serious penalties.
So, the big question is, how do you avoid all this? Look, it's not about becoming a tax expert yourself. It's about understanding the basic landscape and just putting the right systems in place. So, let's talk about the path forward.
Let's just be real for a second. The U.S. tax system for non-residents is complicated. It's super technical, and honestly, it's built around penalties. The whole system is designed to punish non-compliance and to punish it harshly. That's why getting it right from the very beginning is so incredibly important. So what does getting it right actually look like in practice? It really boils down to this: choosing the right forms, carefully reporting every single one of those transactions we talked about, looking into whether a tax treaty between your country and the U.S. could help you, and above all else, filing on time. That is your recipe for minimizing risk and, frankly, getting some peace of mind. So I'll just leave you with this final thought. You built your U.S. company on a great idea, on ambition. But the real question is, have you built a compliance foundation that's just as strong? One that's built to last so you can thrive without getting derailed by some of these costly and totally avoidable tax penalties. Thanks for watching.